Welcome to the Real Estate 401k Show. Here are your hosts, Ryan Gertis, Mike Weinstein, and Justin Frederick, helping you build a legacy of wealth through real estate. Powered by the Recon Group at West USA and the Frederick team with Fairway Mortgage. NMLS number 625918.
Well, Justin, don't we look cute? We don't plan this. We don't plan this. We don't color coordinate, which there should be some sort of color coordinating app where all your friends are on it, and everybody just says, "This is what I'm. This is what I'm wearing today."
There's an app for everything. I'll bet you, marketed right, it makes money.
Oh, sure.
Oh man, we probably shouldn't release this episode because somebody's going to run with our incredible idea. Well, anyways, we always like to bring the most recent news when it comes down to real estate and when it comes down to lending. And Justin, you are obviously the lending expert, the loan officer for our team and our podcast and things like that. So you're going to have to walk us through this and explain things. There's something out there that's called an LLPA, which most people have no idea what it means. I'm going to explain the acronym and spell it out, and people are going to be like, I still don't know what that is. And you're
all of our military guys will love it because they love acronyms. They love acronyms.
everything's an acronym with those guys. But loan level pricing adjuster. So we know that back in January, there was some changes proposed, and really at the end of the day, it impacts people's debt to income ratio when it comes down to qualifying, when it comes down to rates. That's about as much as I know.
Okay. I'll take it from there. All right. So
thank you.
Yeah. So last week, the FHFA just rescinded the loan level pricing adjuster for debt to income ratio. So basically, when it comes down to it, if your debt to income ratio was over 40%, which 90% of our borrowers are, your interest rate would have been higher, or you would have had more fees and a significant amount of fees.
Which boggles my mind is I've got higher debt, so now they're going to make it harder for me to be able to afford my mortgage payment. But that kind of rationale never made sense to me.
And it's a very difficult number at 40% because a lot of people, like I said, 90% of people are writing on that. And no matter what your credit score was or is, you were being affected by this. So if we're qualifying you by a certain amount of income to purchase a home, well, we still don't have your homeowner's insurance policy for that house. When we qualify you for a pre-qualification, we don't know what the homeowners association fees are going to be or the dues. So we're stepping out on a limb here already by giving you the max that we can, and then knowing that this loan level pricing adjuster may play a role in what your interest rate's going to be. That really had an impact on people. So by them rescinding this is a big deal. This is a big win for clients, mortgage business, real estate. Super excited that this went through because this was actually going against the regulations that they had put in place in 2009 with TRID and RESPA, all that good stuff. We didn't have an active reason for a change of circumstance on these to send out to our clients why your interest rate was going to be higher. People were like, my debt to income ratio. They didn't understand that and how we calculated it. They were thinking that we were doing something wrong.
So I have a couple of questions about income. Because what you have on your W-2 or the gross number on your 1099, that isn't necessarily exactly what income is. So I'm kind of wanting to go down a little bit of a rabbit hole.
Yeah, let's do it.
Because there's a lot of these places or a lot of these folks that they can be the only borrower on there because maybe they're the only one with established credit. But then there's maybe a husband that doesn't have the established credit, so you don't put the husband on there, right? How do you is there a way that they can come up with some additional income based off of that? Is there a workaround so that they can get that income up so that they may not be affected by some of those debt to income loan level price adjusters?
Daddy's getting to dancing at night now.
Yeah, we're going into loopholes here. I love it.
Right.
So there is some ways. Assets. If you have a large amount of assets in certain accounts, we can use assets and divide it by a certain number depending on what your down payment is. So there's a way that we can use assets. Now, If you have some sort of income that's non-taxable, like let's say you have a disability income or Social Security that's non-taxable, we can gross that income up.
And what about child support?
Child support can be grossed up. You got to have 3 years minimum remaining on that child support payment, so 36 months from the time we close. A lot of our veterans have housing that we can gross up, things like that. We can gross up that income, and it depends on what type of program that we're in. Will depend on how much we can gross it up.
So okay, I'm sorry. Go ahead.
So there is avenues that we can find more income, but when we're talking about 1099 income, 1099 income, you're self-employed.
Sure.
So either you're filing a Schedule C or an S corp or something in that nature. You're going to want to look at what your net income is, not what your gross income is. So after all your deductions, now there is things that we can put back into your income, but most people don't have a lot of add backs into their income as self-employed. But that's something that we would want to take a look at to see, because there is people out there that have a lot of add backs into the income on their self-employed income from the tax returns.
So I guess to be a little bit more clear, would it work? Let's say that I didn't. Let's say that my credit wasn't established.
Okay.
And my wife's was.
Okay.
So we're doing all of our real estate purchasing under my wife's name. So we're not seeing any of my income on there. Could I be an employee of hers or she be an employee of mine to where we can siphon income from one to another?
Well, that would be called coaching, and I'm really not supposed to do anything like that. But if you had 2 years tax returns where it's showing that you're doing something like that, and the business is proving to continue to get better, absolutely. Absolutely.
You heard it here now.
I don't even know where to go with that, dude. I've never heard that.
I can get a little bit deeper on this too with conventional loans. So have you ever heard of blended credit? I think I've talked to you guys about that.
Yeah, okay.
So blended credit, you may not have a great credit score. You may have a low credit score, but if your wife has an 800 credit score, we can actually use an average through Fannie Mae, which is a conventional product, to do the loan. And I've actually had somebody where they've used their parent. Mother had, I believe it was a low 800 score. Daughter had a low 500 score. We put them both on the loan. They had 20% down. No big deal. We were able to do it.
Okay.
Yeah.
All right. Well, since Ryan has successfully diverted us from the original conversation,
Well, it had to do with debt to income and how we can bring more income to avoid LLPAs.
well,
issues.
so I will go down this rabbit hole. I'll play this
Let's
game. One of the common things that I deal with when we are dealing with independent contractors, people who own their own business and are not W-2'd, the temptation obviously is to write off as much as you can, keep as much of your money as possible, not give the IRS or Uncle Sam, their obscene share.
Yeah.
But then when the time comes to buy a home, because you've written off so much and you showed actual little income,
Or losses,
but you've actually made a ton of money, it's now very, very challenging and can be very, very challenging. So what is that balance for people who are thinking about buying a home and they...
Well, it's give and take, and it's different for everybody depending on what your debts are. But I'm going to tell anybody that's out there that's self-employed, make sure that you're paying your liabilities through your business account. If we have 12 months bank statements from your business showing that liability is being paid by your business.
As an example, give us an example of a liability.
So like your vehicle. If you're using your vehicle, have your business account pay for your vehicle. If I have 12 months bank statements showing that vehicle's being paid through the business account, I can exclude the liability from your personal debt to income ratio.
Even though it's on my credit score.
Even though it's on your credit. So there's that. There's now. What was your initial? Because we went down a rabbit hole right there. But you were talking about.
Well, we originally started talking about the LLPA rescission.
But there's all kinds of avenues that we can go down with self-employed. Oh, you were saying what's the average look like? What does somebody need to do?
Yeah, well, what's the strategy? And for me, and I'll throw you a softball here. For me, is if you are self-employed, one, and you're thinking about buying a home, one, do not file your taxes yet until they speak to you, because you can help give a little bit of insight and some strategy when come filing your taxes. Or if you think you're a year out, have that conversation with your team right now, because we can
build a plan.
And the strategy when it comes down to write-offs.
100%. I completely agree with that. We definitely can help you build a plan to maybe, I mean, obviously I can't help you increase your sales and things like that, but
you did mention the word coach earlier.
If you, yeah, I'm not coaching, but if you know what you're looking to get for, I can help you understand what you need to be at. How's that? But there is another avenue. So let's say you are the guy that writes everything, or woman that writes everything off, and you're showing a loss. Well, we do have a broker avenue where we can use bank statements. We can use 12 or 24 months bank statements to take income off of those bank statements. We're also going to have to count for the expenses that are shown on the bank statements. But we can get you a loan that way if we have the income to qualify for a certain home. Now, those types of programs come with higher costs. They come with higher interest rates as well. So understand, if you're not claiming it to Uncle Sam, you're not going to pay the big amounts of money to Uncle Sam, but you're going to pay it with your mortgage interest.
They're going to get it somewhere.
Yeah.
We once had a client and come through, and one of our team members was working with the client, and he calls me one day and says, "Okay, so she's got the 5% down, but it's cash." I'm like, and I thought it was a joke. I'm like, come on. He goes, "No, really," and sent me a picture of this lady
all
with
this cash.
all this cash.
Was she throwing it up in the air?
She making it rain.
Was she laying on the couch with it all over the?
There was not necessarily any question or any point. I just thought I was
Going to the brass tacks of the LLPA DTI rescission. What was it before? What were they trying to make it be? And is it going to be any different than what it originally was?
Good question. So there was no debt to income ratio add-on for your interest rate or pricing before. It was going to be 3/8 of a point, so 0.375 added to cost, or it could slide into the interest rate.
So instead of 6, it would have been 6.375.
No, because it's not an interest. It's not actually to the percentage of the rate.
Okay,
so it's actually points. So correct.
Got it.
So most likely it would have been, instead of 6.125 interest rate and APR.
Well, this is exactly why not all loan officers, not all lenders are created equally and bring the same level of experience, and especially if you're an independent contractor. But no matter who you are, if you are thinking about buying a home, it is imperative that you talk to somebody who's familiar with the myriad of programs out there that can help you get to your goal. And that's why, Justin, you are part of our team, and why every time I go buy a house, I call you.
I appreciate it.
All right. Well, we want you to be able to reach Justin and have that conversation with him. So go ahead and break out your phones. Text the word money to 623-AZ-RECON. That's the word money to 623-AZ-RECON.
Thank you for joining us on the Real Estate 401k Show. If you want more information on how to build wealth, click on the link or text us at 623-297-3266. That's 623-AZ-RECON.